Okay, good afternoon. Thank you all for joining us today. I'm Sue Dickman, the CEO of the Jewish Communal Fund. Today is Giving Tuesday, and I'm delighted that JCF is able to offer this very helpful practice management webinar on charitable giving to our advisor network. In the increasingly competitive worlds of wealth management and financial planning, advisors are looking for ways to provide a better client experience. One of the ways to deepen client relationships and add value is by increasing your knowledge of philanthropy. In fact, research shows that the overwhelming majority of high net worth and ultra high net worth clients are already involved in charitable giving. In today's webinar, we'll provide you with more information about charitable giving trends and discuss how to ask the right questions to elicit thoughtful responses to help you create effective and personalized plans for your client. These tips will help you build a stronger relationship with clients and engage them as an active participant in a more holistic planning process. Right now, I'd like to introduce our speakers, Ellen Israelson and Susan Schoenfeld. Ellen Smith Israelson is the Vice President of Philanthropic Services at the Jewish Communal Fund. She heads the Private Client Group and runs the Family Office Roundtable and JCF's Advisor Network. Susan Schoenfeld is the CEO of Wealth Legacy Advisors, which serves as thought partner to families of wealth. Susan provides guidance on stewardship, governance, generational legacy and wealth transfer, philanthropy, and managing fiduciary risk. Susan is a self-described recovering attorney and CPA and an author. After leaving Trust and Estates Law, she ran the Trust Administration Department for 14 years at a trust company. And then she was family ambassador for a $600 million single family office. Susan's passion is helping families and their provider organization with the tools to take them to their full potential. So let's get started. Ellen, can you give us a snapshot of the major trends in charitable giving?
I'd be happy to, and welcome to all our friends in the advisor community. As you can see on this chart, last year was an extremely good year for charitable giving. It hit a record high of $410 billion, and this chart shows how dramatically it has increased since the recession. And not only has the economy made a terrific recovery, but you see it in the 30% increase in charitable giving since the recession. So let's take a little bit of a look at where all of this money is coming from. Consistent with what has happened in charitable giving trends over the decades, the overwhelming majority of the money does come directly from individuals, 70%. And if you add in the bequest at 9%, you're looking at almost 80% of all of that $410 billion is coming from individuals. Very small portion here from corporations, and that's been an ongoing trend. Corporations have not played a very significant role in the corporate giving, in the charitable giving sector for decades now. And at 16%, a fairly significant amount is coming in from foundations, this meaning community and operating foundations. So basically that tells us that despite some misperceptions about clients, they tend to be extremely charitable. 80% of this money is coming from individuals. So it's more likely than not that your clients are interested and concerned about charitable giving. Another interesting factor to consider as we look at what drives charitable giving, obviously there's people's own personal core values, there are tax considerations, but clearly the market has a very substantial effect. And this shows the very dramatic correlation between the S&P 500 and charitable giving over time. And while there is a bit of a lag between where the market is in charitable giving, the correlation is extremely close. So with the market still relatively high and employment very high, Even though there's some concern and skepticism, we still feel that this could be another robust year for charitable giving, and certainly worth having the conversation with clients. Just to drill down a little deeper to think about who's giving and how they're giving, 70% of Americans report they contribute to charity on an annual basis. 91% of high net worth households do give to charity. And another trend that we're seeing very dramatically, certainly on the front lines here at JCF, but across the entire charitable community, the increasing use of the donor-advised funds. Donor-advised funds grew a whopping 60% this year, and grants from donor-advised funds, which we believe is a really important indicator of people's interest in giving. The grant making out from these funds grew 20%, up to $19 billion that went out into the charitable sector. In addition, assets in private foundations increased significantly, and even there was a modest increase in grant making. But still, because the number of assets are so large in private foundations, even this modest increase in distribution in terms of grants from private foundation resulted in $50 billion put into the charitable stream. So it's very significant.
We often hear from advisors that they find it difficult to introduce the topic of charitable giving with their clients. Susan, can you give us some suggestions about how to approach this? Are there specific clues we should be listing for when meeting with clients?
Well, not only is today Giving Tuesday, but we are but 1 month away from year end. So as advisors, you're having year-end planning conversations with your clients. Are they talking about offsetting their personal income tax or capital gains tax? Is that something that they're considering? Given the recent tax changes, charitable contributions are one of the few remaining tax deductions. Some clients may have additional income streams this year. There are various ways that you can offset that, or perhaps they want to provide an additional income stream. You can talk to your clients about a charitable remainder trust. As many of you know, a charitable remainder trust is a mechanism to provide an annuity, essentially the income inside the trust, either for a term of years, up to 20 years, or measured by the recipient's lifetime in a very tax-advantaged way. It's actually a beautiful thing because you can get the income tax deduction now, and if you sell an appreciated asset inside the charitable remainder trust, the capital gain is not taxed because it is a tax-exempt entity. And then the most beautiful part is at the end of the term, either at the end of the 20 years or at the end of the measuring life, the remainder goes to your favorite charity or to the family's donor-advised fund. So a charitable remainder trust is definitely something you can be talking to your clients about if they want an additional income stream now, and or if they are sitting on a large unrecognized capital gain. Are your clients talking about preparing their children to inherit their wealth? In my experience working with families of wealth, that is the #1 question that I get. How in the world do I prepare my children to inherit a significant sum of wealth? And very often the answer, if the family is of philanthropic intent, is to use the family's philanthropy, to use the family's donor-advised fund or the family's foundation as a teaching tool, not just as a pure philanthropic tool, but also as a teaching tool, a way to get the younger generation involved in the family's philanthropy, involved in the family's asset allocation, involved in regular meetings with the wealth advisors, and generally to get them participating and engaged in the family conversation. very often, and I know we've all heard a lot about the younger generation being really focused on doing well while doing good, and not just giving their dollars away, but also doing something socially good with their investments as well, and aligning their investments with their values. And social impact investing has social responsibility and environmental social to best identify and fit in with the strong returns, to provide a return while also making a social impact. Some of your clients may be talking to you about retirement planning, and that's an area that you can also involve with their philanthropy. You can suggest that they leave their taxable IRA instead of to their heirs, instead to their charity. It could be to a donor-advised fund as the charitable beneficiary, and instead leave another asset to their heirs. And in that way, you are avoiding the embedded income tax inside the deferred retirement plan. The thing as advisors that we are all seeking to add value to our clients is if they have a closely held business and they are contemplating selling it, we all want them to come to us before they sell the business, because there are so many business planning opportunities that we can do before the contract is sold, before the deal is structured. And one potential use of charity involved in pre-sale planning is to contribute a portion of the company's stock to a donor-advised fund before the sale happens. And that's something that you can encourage your clients to talk to you about. And finally, estate planning is something that clients tend to think about at the end of the year. And so this is an ideal time for you to start talking to them about creative ways to transfer assets during their lifetime to avoid estate tax and to incorporate their charitable intent into those plans. On the slide here, we talk about CLTs, and we will get to that in a couple of moments. But I would actually like to talk more about timing the philanthropy conversation, because that's something that's sometimes tricky for advisors to do. And so you do need to listen for those verbal cues, as we talked about, some of the different things that we talked about on the previous page. But as advisors, whether you are the CPA, the accountant, the wealth advisor, the wealth manager, there are many different opportunities to talk to your clients about the philanthropy conversation. This is the time of year when you're starting to take stock of how your clients did this year. Have they had a really good year and they need a tax deduction offset in order to mitigate their anticipated income tax burden? Do they have highly appreciated securities that they can make a donation with? Are they expecting an inheritance, or did they just have some other windfall? Are they preparing to sell their business? Or sometimes the client will just bring right up with you. They're talking about a particular charity or charitable vehicle. I went to a holiday cocktail party and somebody talked to me about this thing called a Donoradvised Fund. I've never heard about that before. Can you explain it to me? So all of those sorts of things are excellent opportunities. They're excellent verbal cues for you to bring up the conversation with your client, particularly today being Giving Tuesday, particularly today being a month away from year end. This is the time when your clients are ripe to have these types of conversations with you. And you can really add value and make a difference in your client relationship.
Ellen, can you give us some insight into the non-tax related motivations and concerns that can help drive the philanthropy conversation and help an advisor assess their client's needs?
Sure, and thank you, Susan, for explaining some of the clues and triggers to help advisors know when to approach the conversation. So let's talk now about some of the questions. I always recommend starting with a values-based conversation, open-ended questions. This leads to also a more holistic picture of what the client is trying to accomplish. And I think it helps you in all the planning that you try to do for the client. You can start with some very open-ended things like, what does success mean to you? What are you trying to accomplish with your wealth? That is much broader than just talking about tax issues and structures. How do you want to be perceived by your family, in your community? What values are important to you, and how does this relate to what you want to accomplish? You can also start to get more specific if you see the client already leaning towards inquiries about philanthropy. Where do you see charitable giving in your planning? What would you like to accomplish with your giving? And I think this is very important before someone jumps right into structure, because the type of impact, the type of time frame, who the clients want to involve in their giving, all of these are going to play into ultimately coming up with the right strategy and the right structure. And then also, is it a greater focus on giving in lifetime, or is it really about the legacy that they would want to leave? So I think these are all very helpful questions. And if you have any hesitation about jumping in and starting to have this conversation, it's interesting that in 2 consecutive US trust studies of high net worth individuals, they all expressed concern that the advisors waited too long to bring up the topic of charitable giving. And we're also concerned that advisors tended to focus right away on the more technical aspects without having this more holistic conversation with clients. So basically, you have to find the balance and use all the information from both the tax and technical considerations, as well as the personal goals and values.
Susan, can you give us a brief refresher on the most commonly used charitable vehicles? And can you provide a comparison of the Donor-Advised Fund and the private foundation, the 2 most popular vehicles?
So this is a very important step, perhaps the most important step, for looking at all the factors that inform the decision about structure. So as Ellen talked about, the values question and the motivation for doing it in the first place is paramount in helping to decide which structure is most important. Also, what is their time horizon? Are they interested in building a philanthropic structure that will live on and be managed by future generations of their family? Or do they prefer to allow each generation to craft their own philanthropic structure? Help your clients explore what matters most and suggest the ideal structure that will best accomplish their goals, is tax efficient, financially satisfying, and emotionally satisfying. So consider whether your client and or their family needs income as well as tax savings. If so, the answer might be the charitable remainder trust that we talked about earlier. Consider the time horizon. Do they want to make the charitable gift now, or do they want it to be after they pass on? Those are the types of things that you might consider whether you're making a split interest gift like a charitable lead trust or a charitable remainder trust, or you want to set something up like a foundation or a donor-advised fund. The big question for clients, as we know, is control. How much control do they want of the grant making and of the investments? If they want ultimate control, then a charitable foundation might be for them, or in certain cases, a donor-advised fund provides almost as much control as a foundation in terms of grant making and investments, but there is always subject to approval with a donor-advised fund. Another big factor for the ultra-high net worth families is the privacy question. Do they want their name on the building or on the wing of the hospital, or do they want their giving to be private? If they want their giving to be private, then a donor-advised fund is far more preferable than a private family foundation, because private family foundations require tax reporting, and they require that the tax document, the Form 990, that the foundation must file each year needs to be published. And one place that it can easily be found is an organization called GuideStar. And if you go on there, you can see the 990s for all the private foundations. And sometimes when I meet with families, they're shocked to find out that their foundation, which they thought was private, isn't nearly as private as they thought it was. And if privacy is an important feature for your clients, then yes, a donor-advised fund is a far better vehicle. Flexibility is the next factor. How flexible do they want this charitable entity to be? Charitable impact, how do they define it? How do they define the impact that they want and the scale that they want? Are they defining it by sector? Are they defining it by geography? Are they defining it by the need being resolved? How specific do you want to define your impact? And finally, fundraising. Is this strictly a family philanthropic vehicle, or is this something that they're actually going to be soliciting funds from others? Once you consider these factors, now you're armed with the information you need to create the best structure to help your client. So what are the structures that may be used for charitable giving by an individual? Well, some of the common structures are a private foundation, as we've talked about, the donor-advised fund, which we're going to talk a lot more about, and the charitable lead trust and the charitable remainder trust, which I've talked a little bit about the remainder trust. Charitable lead trust is in many ways the inverse, the mirror image of the remainder trust, in that in the remainder trust, either the donor or typically a member of the donor's family receives the income for a term of years or for life, and then the remainder goes to charity. In a lead trust, it's exactly the opposite. The charity receives the income either for a term of years or measured by a lifetime. And then at the end, the beneficiary, typically a family member, a descendant generally of the donor, gets the remainder. They have very different tax consequences. Even though they sound very similar, there are very, very different tax consequences, which are really beyond the scope of this webinar. But I did want to bring them up because in certain circumstances, either a lead trust or a remainder trust could be a really efficient way for you to advise your clients. In general, what we're going to be talking about now are the differences between the private foundations and the donor-advised funds. They do have different tax characteristics, they have different purposes and different terms. So as we see here, the donor-advised fund is a public charity for IRS purposes for income tax deductibility. And therefore, if it's a cash contribution to a donor-advised fund, the AGI limitation, the adjusted gross income limitation, is 60% of the donor's AGI this year. In contrast, a private foundation, even if it's a cash gift, the limitation is 30%. So that means that if your client has a very low income, taxable income, adjusted gross income, perhaps they invest all in muni bonds, or they just retired, or there's some other circumstance where they don't have enough income to absorb the size of the charitable gift they're planning to make, a gift to a public charity like a donor-advised fund will be substantially more tax efficient than a gift to a private foundation. If the client is not giving cash, but instead they're giving appreciated property, public securities, the income tax benefit is still better with a donor-advised fund than it is a gift to a private foundation. So with a donor-advised fund, if the client is giving securities, the limitation is 30% of adjusted gross income, whereas a gift to a private foundation is 20% instead of 30%. And generally, you've also got unless it's qualified appreciated stock, you've got any other appreciated stock property given to a private foundation is going to be limited to basis, not fair market value. So as we've seen, strictly for tax purposes, there are substantial benefits for giving to a donor-advised fund, and that's because the donor-advised fund is treated as a public charity and has higher limitations. In addition to those differences, there are additional differences in terms of structure. So many of you know that a private foundation does require an annual minimum payout of 5%. Under current law, a donor-advised fund still does not require that minimum payout. The IRS has been talking for years and years about wanting to impose one, but they still haven't done it. So I would still say that it is a very popular feature amongst donor-advised funds that there is no minimum payout required. In addition to that, when a family sets up a donor-advised fund, the fund itself does all of the administration for the family. But instead, when they set up a private foundation, the family has to do the administration. They have to write the checks. They have to prepare the tax returns. They have to hire the lawyers, the accountants, and other advisors. Whereas with a donor-advised fund, all of that is done for the family. It's much easier for the family on doing administration. Another difference is that there are times that a family wants to make a grant award to an individual and not to another charity. And with a private foundation, that's really not possible except with very specific limitations. Whereas with a donor-advised fund, it is possible, subject to the donor-advised fund's rules. So if that's something that you're interested in doing, talk to the donor-advised fund. I'm fairly sure that the Jewish Communal Fund does offer that option. And so, of course, you'll have to structure it with them, but it is something that is possible with a donor-advised fund in contrast to a foundation. Sometimes families want to create a program, a scholarship program or some other special program within the charity. And that is something that you can do with both a donor-advised fund and a private foundation. But again, with the foundation, the family has to do a lot more administration and it requires a lot more energy. There is a cost to having a private foundation. You have to hire professionals, you have to file tax returns, you have to do a lot more administration. Sometimes you have to hire a staff. With a donor-advised fund, that's all bundled into the service that you're signing up for. So the donor-advised fund will do all of that administration for you. With site visits, the foundation will, so both a donor-advised fund and a private foundation will allow for site visits. A site visit meaning if you're making a substantial gift to a charitable organization, you may want to visit the actual place where the organization is working. Perhaps you're building a wing at a university and you actually want to see it in action. Perhaps you're making a substantial gift to, I don't know, an animal shelter and you want to visit there. There's any number of sites that you might want to authorize a visit to make sure that your intended purpose is being satisfied. And then finally, and I've talked about this before, but a huge differentiator between a donor-advised fund and a private foundation is privacy. With a private foundation, the Form 990, which is the annual income tax return report that the foundation needs to file, is available for public inspection, and absolutely anybody can download that and have a lot of information about your charitable giving. With the donor advised fund, it is significantly more private.
Ellen, since you work at JCF, can you give us some information on the Donor Advised Fund, and what are some of the smartest ways for clients to organize their giving and maximize their tax deductions this year?
Sure. First, I just want to clarify one of JCF's policies in terms of the grant making to individuals. That is not something that we do. Everything goes out to other 501c3 public charities that have parity with our level of deductibility. But we do work with organizations that then these other public charities are supporting specific individuals. For example, the Jewish Joint Distribution Committee does a lot of direct funding to individuals, but our grants go to them and don't specify individuals. Basically, with this tremendous growth that's happened in the donor advised fund world, it's good to be able to hone in and recognize which clients can derive the most benefit, who are the best candidates for the donor advised fund as opposed to a split interest trust or a private foundation or some other strategy. Basically, your client who never has their receipts, who doesn't know where anything is, they're frustrated, they have things on Excel sheets and little pads of paper, those kind of people really need to organize and streamline and can benefit tremendously. Clients who are a little more tech savvy, who do their investing online, their banking online, their bill paying online, these people segue very nicely to philanthropy that's based on a technology solution like a donor advised fund where you would see your balance, make your grants, monitor your investments all through your online experience. Clients may have been giving small amounts over the years and not been extraordinarily engaged with philanthropy, but if they're about to experience a significant wealth event, whether it's the sale of a home or a business or an inheritance, these people can really benefit from a donor advised fund because it allows them to make the more significant contribution up front and then gives them time to be thoughtful and educated and strategic about how they want to approach their charitable giving. I think everybody has clients that hopefully these days have highly appreciated securities. One of the great things about making the gift is that you're not dealing with the capital gains and you are taking the deduction at the fair market value. The other thing, and people don't automatically think about this, but this is an opportunity for really game-changing philanthropy. Clients who want to or have complex assets, such as privately held corporations, real estate, rights, oil rights, gold rights, these complex assets come with all kinds of tax issues and it can be very substantial. Gifts of these complex assets have created enormous charitable funds for people that are doing very high impact work, and almost all donor advised funds will accept these on a case-by-case basis. There is a lot of diligence and vetting involved in accepting such gifts, but most donor advised funds will do this. The other thing to look at is ease of distribution. The client may have a private foundation and they may have a charitable lead trust, but they don't necessarily want to make every small gift out of that entity. Some people just pour a lump sum from another vehicle, such as a charitable lead trust, into the donor advised fund because it's as easy as taking out the phone and making all kinds of grants, large and small, to a variety of charitable organizations. Susan really went over all of the privacy issues, in addition to the fact that donor advised funds report in the aggregate, so there's no disclosure on an individual fund holder. You can actually make grants anonymously, which some people choose to do. This is a really great situation if you're working with clients who have blind trust and need that extra level of anonymity and privacy. We also get involved with a lot of multi-generational families, and this is a beautiful way to bring families together and engage them in an expression of their values. So we have funds that have grandparents and grandchildren, or parents and children. We don't limit succession, so we can continue for multiple generations. So those are some of the people who will really benefit from using a donor advised fund. Another thing to think about when you're helping your clients look at the charitable giving and some of the tax issues is front loading their charitable giving, and what's now being called bunching. So the client can look forward 2 or 3 years, estimate what they would normally give out to their charitable organizations, and instead bunch that together, particularly if they also have appreciated securities. That's a sort of extra benefit there, and put it into a donor advised fund. As we don't have a specific required distribution each year, it's easy for that money to be used over 2 or 3 years, and the deduction can be realized in the year in which they itemize, the year in which they give the money to the donor advised fund. So that's a great benefit. As well, in most donor advised funds, certainly at JCF, there are a variety of investment options, and they will be earning tax-free income that's rebalanced into the fund. So this is a very smart way for people who are not sure they're going to have enough deductions in this year to itemize. Front loading the charity, the charitable donation will get them there. Again, we talked about the appreciated securities. The securities must be held for at least a year and a day. Publicly traded, not restricted, although sometimes restrictions can be lifted, and people do claim the fair market value. So this is really, even in years if people haven't had a raise or a bonus, taking a look at the securities and finding those low basis stocks may be the best strategy to maximize people's giving. And as we mentioned before, looking for the most advantageous asset for the client. It may well be cash or publicly traded stock, but it could be real property. We have over the years taken many properties, complex assets. It could be off-mission giving from a private foundation. It's very cumbersome for families to always have to call a meeting to make every minor distribution, discretionary distributions, off-mission distributions. So many people together with the private foundation as a side-by-side use both the donor advised fund and the private foundation. It gives them that extra level of flexibility. And of course, any type of trust. It can be a split interest trust, or it could be any kind of trust, is able to make contributions into the donor advised fund. One thing to keep in mind, though, you cannot go from the public charity, like a donor advised fund, back to anything private, like a private foundation, because you've already put it in at the level where someone is receiving the highest deduction. So you can't go back to something that qualifies at a lesser level, and where the client has additional control. So I think that covers most of our tips about talking to your clients and strategies that could help them. And I think we'll open it up to questions.
Hi, everyone. So we're going to ask you to, your lines are still muted, so please type your questions into the Q&A box that's at the bottom of your screen. We'll give you a few moments to do that. Okay, we just got a question from Nicholas. He's asking, is it possible to apply the donation to your taxable income, i.e. salary, versus the capital gain portion of your AGI?
So it's not quite as targeted as that. You add up on page 1 of your tax return, you add up all of the income, including your salary and including your capital gains, and then you apply your deduction to that. So it's not quite as targeted as applying your donation against your salary or cherry picking it to be against your capital gain. That's really something that you need to talk to your tax advisor more specifically about.
Yeah, absolutely.
Okay, and we have a question from Jonathan. What kind of fees does your donor advised fund impose?
We have a sliding scale of fees depending on the size of the fund. The lowest fee here is $150 for the year on funds with balances of $20,000 or less. Then it goes to 75 basis points, 50 basis points, and it continues to lower as the assets in the fund are larger. I'd say there's quite a range of fees in donor advised funds. The administrative fee in some places could be as low as 40 or 50 basis points. I've seen them as high as a little over 1%, where JCF is somewhere in the middle. But I would caution, as you're evaluating the fees from a donor advised fund, to make sure you look at the management fees on the investment as well, because some donor advised funds are able to negotiate much more competitive management fees from the various investments than others. So it may look like you're only doing 50 basis points on administration, but if they're 30 basis points higher on the administrative fee, you still could be paying more. So you've got to look at the totality of the fees that are involved.
Thank you, Ellen. And then we have another question. Will the DAF accept real estate or artwork?
So we definitely, and on a regular basis, accept real estate. That also goes through a fairly thorough legal vetting. There has to be an independent appraisal that's submitted, and there are obviously concerns around leverage on a property, because then you're going to have certain other tax issues, unrelated business tax issues and so forth to deal with. And you have to look at risk and holding and liquidity. So we take all those factors into consideration. But real estate, especially highly appreciated real estate, can be an excellent asset to use. Susan, did you want to say anything about some of the tax or other concerns about gifting real estate?
Well, real estate does not count as a qualified security, so it would not, in many cases, be eligible for the higher deductible percentages that I talked about earlier, which were only for qualified securities. So once again, that's something that you would need to consult with your own tax advisor on.
In terms of art, I would just add, donating art is very tricky for a variety of reasons, but one of the things you will face, whether you're giving it to a donor advised fund or any kind of a charitable organization, is you're only going to get the fair market value if it's related use. So if you're not giving it to a museum or an educational institution that's teaching about art and history and is going to use this for related purpose, you're not going to realize a significant deduction. Did you want to elaborate on that, Susan?
That's exactly right. There is a huge body of law surrounding the donation of art to charity, and exactly what you said, Ellen. Unless you're donating it to a museum or some other entity that will use that art for its own main business, like a museum, it is very tricky and is not it is not nearly as straightforward as you might think.
Okay, and now we have a question about life insurance policies. Whether do you accept and hold life insurance policies with the DAF as owner and beneficiary? And are there $0 future premiums, or does the donor make annual gifts to the DAF to cover premiums?
Most of the life insurance policies that we have dealt with, we have simply been the beneficiary of a policy that the individual held. I do believe that DAFs can do this. They can decide to pay the premium for people. I don't know if we're currently doing that at all. Sue, did you want to?
We have taken some life insurance policies and do pay the premium for some.
Oh, good.
And I believe other donor advised funds do that as well.
Yeah, when I used to run a donor advised fund for another institution, I don't have a recollection of taking a life insurance policy, but it's good to know. Thank you, Sue, for sharing that.
Great. And then we have a question about processing grants to foreign charitable organizations. Nicholas wants to know if that's something we do.
So yes, we do that, but the challenge when there is no either an American Friends of 501c3 public charity that has a tax ID number here in the US, and they don't have a US-based fiscal sponsor that would be, at that public charity level and reporting to the IRS, then you have the challenge of what we call expenditure oversight. So who is monitoring where the money goes? Who is doing that boots on the ground look at, is the money getting to the place it's supposed to be, and is it used for the purpose it should be used, and is this a legitimate charity? In some cases, we do a lot of giving in Israel, for example. We work with PEF, which is an intermediary. There are a number of other groups like NGO Source that have people in Europe, in Asia, Africa, and they can do this type of oversight. What I would caution is working with a donor advised fund or an organization that will simply send a little card to the charity, the foreign charity, and say, oh, just please check these boxes or certify that you're using this correctly. People have had some terrible surprises when there is really no one charged with that oversight, and I can't stress how important that is.
I would absolutely agree with that. What I caution families who want to make grants to foreign organizations is to seek out whether there is an American Friends of option for that charity. And generally there is, because generally foreign charitable organizations that want American dollars know that in order to be published in publication 78 by the IRS, and in order to get an eligible deduction on a US tax return, it is just much easier for them to form an American Friends of entity right here. And so generally, unless it's a brand new startup organization or there's a very specific reason why they don't want to enter into the American Friends of type situation, it is definitely the way that I recommend.
Yes, we've had a lot of success with using NGO source for those organizations that are not listed as American Friends, and they do what's called the equivalency determination and determine whether the organization, if it were listed here, would be equivalent to a 501c3 here. So we have used them with some degree of frequency and success. Are there any more questions?
That was it.
Okay, then I'd like to thank Ellen and Susan for a very informative webinar. I think there's a lot of great information here on how to talk to clients and what are the different vehicles. So I thank you for that. And I thank all of you for joining us today, and wish for those celebrating an early happy Hanukkah and a productive giving season. So thank you for being with us.
Thank you.
Thank you very much.